Okay, let's do chapter 11. Wow, that was brutal. I'm gonna have no voice left after this, but I guess that's the way it works when you do a class in 6 weeks, right? All right, cool. Thanks, guys. All right, chapter 11. So in theory, we've gone through the acquisition of property. We've gone through the cost recovery of property through depreciation and amortization. This chapter is all about getting rid of that same property through a disposition. So learning objectives, we're going to talk about calculating the amount of gain or loss recognized on the disposition of assets used in a trade or business. We're going to talk about the character of that gain or loss. We're going to talk about the rationale for and the calculation of something called depreciation recapture. We're going to describe the treatment of what happens when we have unrecaptured depreciation under 1250. And we'll talk about what happens if we sell property, trade or business property to related parties. We'll talk about 1231 gains and losses, and then a handful of exceptions to the general rule that any realized gain or loss is recognized. This chapter is just brutal. All right, so remember this. If I have a sale, exchange, or a disposition, then I know I have an amount realized minus the adjusted basis. That generates a realized gain or loss. I can then deduct any deferred or exempt gain or loss, and that would leave me the recognized gain or loss. And look, we're just going to use this 1,000 times before this module's done, 5,000 times before this semester's done. It's back and it matters, right? If I have a disposition, the amount of gain or loss that taxpayers realize on the sale is amount realized, magic tax word, less adjusted basis, magic tax word. What is the amount realized? The amount realized is the amount that you receive in value from the buyer minus any selling costs. So that's an interesting conceptual perspective. I like to think of it as what'd you get, but technically you calculate it as the cash you receive plus the fair market value of any property you receive plus any of your liabilities that the buyer assumes minus any selling expenses. So similar to the gross income rules, like it's not relevant what form that compensation comes in, right? If they pay you cash, okay, I get it. If they pay you chickens count as amount realized, just like they counted as gross income. So Scrap Happy is a scrapbooking retail chain, owns a warehouse subject to a mortgage. Manufacturing company says, you know what, we'd like to buy your warehouse for $15,000. We're going to also give you a $30,000 note receivable, and we're going to assume your mortgage. So if Scrap Happy says, you know what, I'll take that, and then they incur $1,500 in selling expenses, what is their amount realized? That's the $50,000 liability assumed, plus the $15,000 in cash they receive, plus the $30,000 note receivable minus the selling expenses. That's as tough as it gets for amount realized. What is the adjusted basis? Well, guess what? We got that now, right? We covered that last chapter. It's the original basis reduced by depreciation or any other form of cost recovery that's been taken against that property. So cost minus cost recovery, that's your adjusted basis. Depreciable property placed in service costs $10,000, 3 years of depreciation, $7,120. So the adjusted basis is down to $2,880. If 179 was used, if I assume it's not limited, then my adjusted basis is 0. Bonus depreciation is used. If it's 100%, it's all written off in the year in which I place it in service, the adjusted basis is 0. So just to point out, those special depreciation methods affect the adjusted basis just like depreciation does. All right, so generally in order to trigger something to be a realized gain or loss, we need an event. So recall back in module 1, we talked about someone, I can't remember who, bought some stock, held on to the stock, it appreciated at year end, they didn't sell it. We described that as an unrealized gain or loss. That's the case. We need to trigger an unrealized to some sort of realized event. So let me just talk about that. A sale, exchange, or a disposition are all considered realization events. There are a few exceptions, right? So there are some forwards and futures contracts, if any of you are into commodities, that you actually have to mark to market before you've realized a gain or loss on them. That's way beyond the scope of this course. So what's a sale? Sale is a transfer of property for money or a mortgage or note or other promise to pay money. An exchange is a transfer of property for other property or services. Other things that we have different names for that meet the definition of a sale, exchange, or disposition: a trade-in, a casualty, a condemnation, a theft, when bonds are retired, when a lease is canceled, granting exclusive rights, that's important, exclusive rights to use a copyright. If we grant an easement or we extend a note's maturity date, those all represent sale, exchange, or disposition transactions, which means that we ought to be thinking amount realized, adjusted basis, realized gain or loss. Transfer of property and satisfaction of a liability results in realization, right? So if I borrow money from the bank to buy a house and I can't pay off the debt, and so I transfer the house back to them to pay off the mortgage, that's considered a realization event. Abandonment, if I just walk away from something, that's a realization event. Demolition, amazingly, not a realization event. So if I have a building and I tear it down and I build a new building, tearing down the old building isn't a realization event. So I tear it down, I'd say, well, what was my amount realized? 0. What was my adjusted basis? Whatever it was. That creates a loss, right? Demolition doesn't create a loss. Instead, whatever basis was left over in that building actually rolls into the basis of your new building because there's no realization of it. Transfers between spouses. I could try to sell something to my wife. I can't sell her anything. So as a result, there's no realization. No, it doesn't matter. Transfers between spouses are not realization events. And there's no realization if I give a gift. But I need to be a little bit careful. If I sell something at less than fair market value, that doesn't necessarily mean that it's a lower amount realized. It could be that there's a gift that's part of that. Again, that's a little bit beyond the scope of this course, but giving a gift, not. That is clearly not a realization event. So let me give you an example. We had a question on the last exam where an uncle gave Evelyn $14,000. Let's assume that $14,000 was in stock. So the uncle gives the stock to Evelyn. Irrespective of whether the stock has gone up in value or down in value, if that truly is a disinterested gift, then the uncle has no realization event. No gain or loss would be recognized. He's just out the stock. It's just gone. And now it's in Evelyn's hands. All right, I loves me a good summary. So this is right out of the book, right? So yeah, you better believe it. You may refer to this. If I were thinking of crap I'd have around handy when I was taking an exam, this is the kind of crap I'd have handy. All right, so as previously mentioned, I have to recognize gain or loss generally from a realized gain or loss on disposition. Recognized means that I increase or decrease the gross income of a taxpayer as a result of that realized gain, right? So I've got unrealized can shift to realized. Realized generally shifts to recognized. Recognized means I reported it, for lack of a better term, on the tax return. The vast majority of realized gains and losses are recognized gains and losses. What we're going to do is talk about the ones that aren't. That's what part of this chapter is about. Okay, so do you guys remember character? Remember this slide? We talked about people of good character. And we said character counts. And my God, we know that now, right? So we have calculated ordinary taxes and we have calculated long-term capital gain taxes. And we recognize now that there is a difference. There is certainly a difference between an ordinary rate of 24% and a long-term capital gain rate of 0. So we know that individuals generally prefer capital treatment. We also know that there's absolutely no rate difference whatsoever for corporations. Corporations pay 21%, whether it's ordinary income, capital gain, or not, just doesn't matter. But we know that capital losses are limited. So as a result, if a corporation never generated any capital gains, those capital losses would ultimately just get stranded and ultimately evaporate. So as it turns out, even corporations generally have a preference for capital gains over ordinary gains. Okay, so Hogwarts generates a long-term capital gain of $55,000, a long-term capital loss of $100,000. It also generates $400,000 in ordinary income. The net capital loss from this is $45,000. That's the $100,000 of loss, the $55,000 of gain. Since none of that is deductible, a net capital loss is not deductible by a corporation, their taxable income just remains $400,000. If we assume that there is no carryback, the only way Hogwarts could recognize that loss is if they generated a capital gain. So that's why, yeah, as it turns out, corporations want some capital gains. Okay, remember back to Chapter 7. One of our problems is property used in a trade or business is not capital property. Remember the not list? That's on there. So that means, good God, how's a corporation ever going to generate capital gains? They would have to have investments, for lack of a better term. Now, a corporation could have that, but that's not generally what corporations do when they're in business. So the problem is they may find themselves in a position where they may generate losses that they can never deduct. Okay, so most gains and losses are in fact ordinary because they come from the sale of ordinary assets. Capital gains and losses generally come from only the sale of capital assets. And this exact blurb that we're looking at now was a blurb we looked at in Chapter 7. And I said, don't worry, eventually we're going to get to 1231, 1245, 1250, and these other things. Congratulations, here we are, I guess a whole week later. Wow, so much time has gone by. So we know 1221, what's not a capital asset. We've seen this list before. The important one on here is right here, trade or business property. Wow, property used in a trade or business is not a capital asset. That means it's an ordinary asset. So ordinary assets, as a result, are, guess what? Assets created or used in a taxpayer's trade or business. Business assets held for less than a year. We're going to talk about why that's subset of the one just previous to it is important. So inventory, accounts receivable, machinery and equipment, all those things are examples of assets that are not capital assets. Recall, if a taxpayer sells ordinary assets at a gain, it's an ordinary gain taxed at ordinary rates. If a taxpayer sells ordinary assets at a loss, they deduct that loss against other ordinary income. So ordinary can be preferred. We looked at this chart already once, right? It talked about holding period. And we said, okay, let's focus on that trade or business column right here, right? So if the holding period is short term, we call that an ordinary asset. Yeah, I get it. We just said that. All assets used in a taxpayer's trade or business are ordinary. But look what we call it if we hold it for more than a year. We call that a Section 1231 asset. Oh, crud. Yeah, guess what? There's no magic name for this, right? There's no other name for it. Everyone calls it 1231. This is unfortunately a lecture that is full of code section names, but I'm only using them when they're the names that everyone uses. Okay, so it's called a 1231 asset. We got to dig in on that thing because that thing sounds special. It is. So do you guys remember this? Right? This is something we looked at in Chapter 7 as well. Let's focus on corporations down there for a second. No preferential rates, taxed at ordinary rates. Can't offset income with any net capital losses, but I could carry it back 3 years and forward 5, as long as I make some capital gains. We said individuals, most capital gains are taxed at 15%. Now we know when it can be taxed at 0%. We haven't really crossed a bridge on any 20% taxable capital gains, but we could do that in the next exam. Presumably you know how to do it. Unrecaptured 1250 gains at 25%. We're not there yet. We're not going to worry about collectibles. What is a 1231 asset? That's a depreciable asset in land used in a trade or business held for more than 1 year. There it is right there, right? An asset used in a trade or business held for more than 1 year. Why does that matter? Well, let's find out in a second. So long-term trade or business 1231. 1231 assets come in 3 flavors. The 3 flavors are pure 1231. That's land. Land's pretty much the only pure 1231 asset. 1245 assets are assets used in a trade or business held long-term that are personal property and intangibles. Section 1250 assets are assets used in a trade or business held long-term that are real property assets. Okay. If a taxpayer recognizes a net 1231 gain, the gain is treated as a long-term capital gain. So that's just a simple phrase, but it's reasonably powerful because we just took something that was an ordinary asset and we said we're going to treat the gain as a capital gain. So let's think about that. You recognize a net 1231 gain, you treat it as a long-term capital gain. So a business sells a bunch of 1231 assets during the year. What are 1231 assets? Anything held long-term used in a trade or business. I calculated out it's a gain. Treat it as capital. Is it a capital asset? Absolutely not. They're not capital assets, but we're going to treat the gain as a capital gain. If I net all those 1231 gains and losses together and it's a loss, then I treat it as an ordinary loss. All right, that's the 1231 rule. That's kind of all there is to it. Now we're going to get to a look-back rule in a second, but that's pretty straightforward. So 1231 gains on individual depreciable assets may be recharacterized as ordinary income under the depreciation capture rules. We're going to get there eventually. So kind of what I'm saying is, okay, caveat, I just told you that 1231 gains are treated as long-term capital gains. When we get to 1245 and 1250, you may see that that is not always true. So what property isn't in 1231? Well, clearly anything you hold for less than a year. Any non-personal use property that results in a net casualty loss, don't worry about that. Inventory, right? Inventory is not a 1231 asset, right? That's not depreciable personal property, and accounts receivable arising from the sale of inventory. Those are the important ones. So again, you net them all together. Net gain, capital gain, net them all together, loss, it's an ordinary loss. So this is a chart from your book. I've covered up what we don't quite understand yet, but you could see the whole thing if you wanted to. So I calculate, for example, on the left, a 1231 gain. I calculate on the right all my 1231 losses. I net them together, right? If I end up with a net gain, it's a long-term capital gain. If I net up with a net loss, it's an ordinary loss. All right. This is from chapter 7. Net gains are capital, net losses are ordinary. This is the best of both worlds, you guys. This is where we want to be, right? So if my gains are capital, if my gains are ordinary, then I have to pay tax of ordinary rates on them. If my gains are capital, then I pay long-term capital gain rates against them. And we're looking at this from the individual perspective because remember, a corporate, there's no preferential rates. So an individual loss, look at the ordinary tax benefit. Why? Because I get an ordinary deduction for it, whereas I only get a capital loss deduction for it if it's a capital loss benefit. So if I sit back and look at this and I say, okay, look at my gains. Which one results in lower tax? Capital gains. That's what I want. Look at my losses. Which one results in a bigger benefit? Ordinary losses. That's what I want. What did 1231 just give me? It said if you net it all together and it's a gain, treat it capital. If you net it all together, it's a loss, treat it ordinary. 1231 gives me exactly what I want. Bill's business has a number of 1231 assets in it now. All right, Bill, I get it. I got 4 assets, A, B, C, and D. There's the basis. There's the market value. There's the resulting gain or loss if he sells these. Got it. If Bill sells all of them this year, it's a net gain of $700. He'd get capital gain treatment under 1231. These are all assets held long-term, used in a trade or business, $700 net capital gain. But what if instead Bill says, you know what? I'm not going to sell everything. On December 31st, I'm going to sell assets A and B only. I'm going to generate a $5,000 ordinary loss. And then on January 1st of next year, I'm going to sell my gains, and I'm going to generate a $5,700 capital gain. The 1231 look-back rule says you can't do that because that's awesome planning, right? Think about it. I just made ordinary losses. I just took all the losses, made them ordinary. I just took all the gains, made them capital. The look-back rule says you have to look back 5 years To the extent you generated any 1231 ordinary losses, this year's capital gain has to be characterized as ordinary. Oh, Christ, are you kidding me? No, I'm not kidding you. That is the rule. So year one, Bill sells assets A and B. He's got that $5,000 ordinary loss. At the end of year one, he takes it. He deducts the $5,000 ordinary loss against his ordinary income. He's loving it. Then in year two, he sells assets C and D. He generates a $5,700 capital gain, except he looks back 5 years. He says, did I sell any 1231 assets at a loss? Yes, I did. Last year, 5,000. As a result, he's got to take 5,000 of this year's gain and treat it as ordinary. 700 is treated still as 1231 capital gain. That's the look back rule. What it does is it forces a business to recharacterize any of this year's gain as ordinary to the extent of ordinary 1231 losses in prior years. It is meant to shut down exactly what Bill did here. Okay, so that's not necessarily an easy thing to understand. The good news is there's at least one homework on there. All right, so now we've got the look back rule under our belt, right? So we say, all right, if I net everything together and it's a gain, I also have to apply the 1231 look back rule. If I had 1231 property I sold at a loss in the prior 5 years, I might have to recharacterize that as ordinary, but whatever's left over still falls down to long-term capital gain. All right, the one that's left, our one secret box, is even more difficult than recapture under the look back rule. This is depreciation recapture. So Lola owns a business that has assets she placed in service 6 years ago. And hold on a second, I gotta shrink that down so I can read my own. There we go. The original basis was $50,000 and it's now almost fully depreciated. Okay, so this asset that she placed in service, it cost her $50,000. She's been depreciating it for 6 years. It's down to $5,000. She's now going to sell it for $10,000. This is her only asset sale this year, and there's no 1231 look back. So we're just making life easy by saying, yeah, we don't need to worry about looking back for 1231 losses in the prior years. So let's look at the history. So over the last 6 years, Lola has taken $45,000 of ordinary deductions. And she's done that on the depreciation she took on that property that she placed in service, right? Because depreciation deductions are just ordinary business deductions. Assume that Lola has a 35% marginal tax rate. She will have saved $15,750 in taxes as she's depreciating that asset over time. That's just the $45,000 in depreciation times 35%. But this is 1231 property. And if it's her only sale, the gain's going to be characterized as capital gain. So that means that the gain will be taxed at only, in this case, we're assuming 15%. So her gain will result in tax of $750. So is it possible that the reason that Lola had any gain at all is because she over depreciated the asset? Now, look, we all know that Lola did things the right way. She used the tables. She had whatever the asset is. She went to the maker's table. She depreciated it based on the prescribed system. But the reality is she depreciated it $45,000 to get a basis of $5,000, and the thing is worth $10,000, right? So maybe her cost recovery doesn't match economics, right? Because it left her with a basis of 5 when its market value is 10. If depreciation tracked economics perfectly, which we can all admit it doesn't. But if it did, she would have only depreciated this thing $40,000. And then the basis would equal the market value at the time of sale. So didn't she really just over-recover her costs? And by over-recovering her cost, didn't she get an additional ordinary deduction that then flips around and becomes a capital gain income? This is a good answer for the taxpayer, but it's a really bad answer for the IRS and revenue. So their question is, should there be a tax break for that? The answer is no. 1245 says if you have 1231 assets that are personal property or amortizable intangible assets, you're going to take the lesser of the gain recognized or the accumulated depreciation and recapture that as ordinary income. Wow. I'm not even sure I know what that means. So I think the only way to figure it out is do some examples. Whatever's left is going to be 1231 gain. Recall that there is no depreciation recapture on assets you sell at a loss. Okay. So another way of thinking about this is to say I'm going to treat the gain as ordinary for the lesser of the gain amount, or that should say or depreciation taken. All right, so here's Lola. Here's our example. The amount she realized was $10,000. Her basis was $5,000. That means she has a realized and recognized gain or loss. There's absolutely no deferral here of $5,000. The depreciation she has taken on that property is $45,000. She needs to recapture as ordinary the lesser of the depreciation taken or the recognized gain. In this case, it's the recognized gain of $5,000. As a result, none of her gain is 1231. It's all recharacterized as ordinary. Let's do another example. Let's presume that instead Lola sells that asset for $40,000. So her basis is still $5,000. Okay, so if we're going to go with this in air quotes over depreciated perspective, she way over depreciated this asset, right? Instead of taking $45,000, she should have only taken $10,000 worth of depreciation. As a result of that over depreciation, she's got a giant realized and recognized gain, $35,000. So I look at the depreciation taken versus the recognized gain. I have to recapture the lesser of those two as ordinary income. That's the $35,000, leaving none for 1231. Another iteration. So now Lola's able to sell that asset for $55,000. Okay, wait a second. She only bought it for $50,000. She shouldn't have taken any depreciation at all. And on top of that, it went up in value. All the same, her basis is $5,000. She followed the rules. She just put it in through the table, and that's what she got. So as a result, her realized and recognized gain is $50,000. She took $45,000 of depreciation. I have to recapture as ordinary the lesser of depreciation taken or gain recognized. In this case, the depreciation is the lesser of the two. She'll recapture or treat as ordinary $45,000 of that $50,000 gain. The remaining $5,000 falls to 1231 character. Okay, let me tell you how I could have solved this problem way faster. So this depreciation recapture, what it's getting at is this arbitrage opportunity that you have to depreciate assets, then sell them back. You take the ordinary deduction and then you recognize the gain at capital. I get it. Okay, what it's not intended to recapture is when you buy something and it actually goes up in value. Because when I buy something and it actually goes up in value, damn it, that's legitimate gain, right? So there's no way you should be treating that as anything but the character it needs to be. So remember, she bought this asset for $50,000. She sold it for $55,000. The second I knew that was true, I knew line F would be $5,000 because that's legitimate 1231 gain. As a result, I knew the rest of it had to be ordinary recapture because all you're doing with all these code sections, 1231, 1245, and in the future 1250, we have not once and are not going to change the amount of the recognized gain. We are simply changing its character. Look at line C and then look at lines E and F. They are always the same. C, 5,000 in the first column, 5,000 in E. In the second column, 35 and 35. In the third column, 50. 45 and 5 is 50. We are just recharacterizing. We are not actually changing the amount of the income they recognize. Okay, one more iteration. She sells it for only $3,000. Okay, well, remember her basis was $5,000. That means she has a realized and recognized loss of $2,000. Okay, well, this is actually the opposite. Lola didn't over depreciate her asset. She actually under depreciated the asset, right? If depreciation followed economics, she'd have taken the basis down to $3,000. She would have had an additional $2,000 of depreciation. Well, but she doesn't get it. So when I have a loss, there is no recapture. Recall that depreciation recapture applies to only gains. As a result, that 2,000 falls down to 1231. Well, what's a net 1231 loss treated as? An ordinary loss. It's the same as depreciated, right? So the way 1231 and 1245 function is the idea is they're trying to make the gains, the ultimate amount of gains and the characters match economics, right? So if we think about all the first three, we made the depreciation we over depreciated match. We said, look, you took the ordinary deduction, you got to add back the gain as ordinary. In the fourth column where we had the loss, we said, well, you missed out on your depreciation that you should have taken, falls to 1231. It's a net loss, treated as ordinary. Okay. So what that means is when a taxpayer sells or disposes of 1245 property, they're going to encounter one of the three scenarios. Number one, they recognize a gain created solely through depreciation deductions. That was the first two columns. They could recognize a gain created through both depreciation and the asset actually appreciates. That was the third column. Or they could recognize a loss. That was the fourth column. So 1245 covers personal property and intangibles, amortizable intangibles. But what about real property? So recall that real property was classified under Section 1250, not Section 1245. So depreciable real property, so for example, an office building or a warehouse, sold at a gain is subject to recapture called 1250 depreciation recapture. So sometimes we call 1245 full recapture, and sometimes we call 1250 partial recapture. I'm going to show you why in a second. So there's also a modified version of the recapture rules called Section 291 depreciation recapture that only applies to corporations. So if you're an individual, a partnership, even an S-corp, Section 291 doesn't apply to you. It only applies to you if you are a corporation. And we'll talk about how 291 works in a second. So 291, if a corporation sells depreciable real property, they need to recapture as ordinary income 20% of the lesser of the recognized gain or the accumulated depreciation. Don't worry, we'll do an example because that's just brutal. So we have this thing called recapture, depreciation recapture, right? And it should function just like 1245. If I over depreciated, then I would treat it as ordinary and the gain would be ordinary. To the extent there was any true appreciation, I'd treat it as 1231 and then hopefully capital. But Congress just flat out loves real estate, right? The US tax code has been in love with real estate for a long time, and it still is. So 1250 recapture says, we're only going to make you recapture, which means recharacterize capital gain, 1231 gain, as ordinary gain to the extent it relates to accelerated depreciation. So not all depreciation, simply accelerated depreciation. That's the part we're going to focus on. Here are our tables for real property currently, right? And this picks up residential and non-residential. So hopefully I put a little circle on these slides. What do they have in common? They are both straight line. Residential rental property, mid-month convention, straight line. Non-residential real property, mid-month convention, straight line. There is no accelerated depreciation on real property. There hasn't been since about 1991. As a result, there is no such thing as Section 1250 recapture. Sorry, since 81. So no such thing as Section 1250 recapture. Sweet. So what that means is if I have real property and I'm depreciating it and I over depreciate it, I do not have to recharacterize that as ordinary because there's no such thing as 1250 recapture. Awesome. But we're not quite done. So what happens to all that depreciation that we didn't recapture? Well, if you're an individual taxpayer and you sell real business property at a gain, what you do is you say, okay, how much would I have recaptured as ordinary if this were 1245 property? I'm going to take that amount and I'm going to treat it as long-term capital gain, but I'm going to apply a 25% tax rate to it. Oh my God, I can't believe someone made this rule up, but they did, right? So that's an individual. If a corporation sells it, I'm going to measure that same unrecaptured depreciation, right? The part I didn't have to recapture. I'm going to take 20% of it, treat it as ordinary. The rest of it stays as a 1231 long-term cap gain. All right. Yeah, unrecaptured is used in the code. It's used in the textbook. I don't think it's really a word, but that's what we call it. Let's redo the Lola example, except this time we're going to look at it like it's real property. So similar to the last time, we're going to treat Lola as an individual. Okay, here we go. Wait a second. This table looks identical to the previous table. In the first column, 10,000 minus 5, I recapture 5,000. In the second one, I recapture 35. In the fourth one, I recapture 45 and 5. And in the last one, there's no recapture, and it goes right to 1231. Wait a second, this looks identical. That's because it is identical. The only thing different is if you look in row E under amount realized, it's described as unrecaptured 1250, taxed at 25%. That's the only difference. Otherwise, you calculate it identical to 1245. So remember, that line on 1245 said recapture is ordinary. In this case, we don't recapture as ordinary, we simply recharacterize as a 25% long-term capital gain. Okay. What if Lola was a corporation? Okay, so this time we have everything's the same, except Lola isn't an individual, Lola is Lola Corp. I think I was listening to the Kinks when I wrote this example. All right, so let's look at this table. Oh, shoot, it is different. In fact, it's so different that I didn't fix it. That should be column G down there at the bottom, but it doesn't matter. All right, let's start in the first column with our original example. Lola sells it for 10,000. That's this one. She sells it for 10,000, and her basis is 5,000. She recognizes a $5,000 gain. Depreciation taken is 45,000. If she had to recapture that depreciation, there would have been $5,000 of recapture. Under the corporate rules, under 291, I take 20% of that amount and I treat it as ordinary. That's row F. 20% of E is the 291 section being invoked. Everything else just falls to 1231. So if I look in the second column, 40,000 minus 5, that's a $35,000 gain. I would have recaptured 35, but it's unrecaptured under the 1250 rules. I take 20% of that amount. That's 7,000. 35 minus the 7 is what falls down to 1231. Under the 55, same thing, $45,000 gain. What's unrecaptured? Sorry, $50,000 gain. What's unrecaptured? The $45,000 of depreciation. I take 20% of that amount, 9,000. The rest of it falls to 1231 character. And then in the final one, it's just a loss. There's no recapture for losses. Wow, that's brutal. All right, so 1239, we're not going to spend a lot of time on. This is one of these rules that the code has invoked, and all it is a trap for the unwary, right? So it's here to prevent abuse. So let's see what kind of abuse they're trying to prevent. This says when you what is the character of a gain on the sale of depreciable property to a related party? And it says that if you recognize any gain selling property to a related party, you have to recognize that as ordinary income. So imagine a situation where you had a bunch of related corporations. And what was happening is the first corporation bought a piece of property, depreciated it fully under the accelerated provisions, but it still has value. So then they sell it to their sister corporation. Their sister corporation just established basis in it and starts depreciating it. Then they sell it to another sister corporation. Their sister corporation establishes basis and starts depreciating it. So what's happening is I'm taking all these depreciable deductions and I'm generating all these 1231 or presumably capital gains. So the rule is, you know what? No way. You sell it to a related party, the gain needs to be ordinary. And that's just going to prevent you from doing that sort of thing that I just described. So it's really just a trap for the unwary. Okay, so now we're into what I call the second part of Chapter 11. So we've dealt with the acquisition of property in in chapter 10. Then we talked about the cost recovery of that property in chapter 10. And now we got to chapter 11 and we talked about the sale of that property, especially business property, and we talked about its character, right? We didn't adjust any of the amounts at all. Whatever the recognized gain was, I may have bifurcated it into two parts, but the total of those always agreed to the total recognized gain. Non-recognition transactions, which isn't really an apt title, but it's the one the book uses. This is a situation where the recognized gain might be excluded or deferred, right? Not just the character changed, we might actually change the amount. Okay, so there are 5 kinds we're going to talk about: like-kind exchanges, involuntary conversions, installment sales, related party losses, and personal losses. These are important because, as I mentioned, that realized gain may not be recognized. I don't like call it non-recognition because under most of these provisions, the gain is simply deferred. So a deferred recognition transaction might be a better name, but it doesn't matter. Let's start with like-kind exchanges. So Jay lives in San Diego, and Jay owns a machine that makes umbrellas. And Kay lives in Seattle, and Kay owns a machine that makes sunblock. All right, so I'm telling you now that why a umbrella factory is in San Diego and a sunblock factory is in Seattle, given the two climates, it just doesn't make any sense. So J and K realize this and they say, hey, you know what, maybe we ought to just exchange machines with each other. Wouldn't that make more sense? Yeah, it would, right? I'll put the sunblock machine in San Diego. I'll put the umbrella machine in Seattle. Awesome. So remember, an exchange is a realization event, right? Sale, exchange, disposition. Exchange means amount realized minus adjusted basis, realized gain or loss, maybe recognized gain or loss. So if we assume that J and K have realized gains, if they're recognized, where would they get the cash to pay for this, right? Because remember, no cash exchanged hands. They just exchange machines with each other. Kind of, there is no cash in a true exchange. Well, how are we affected with our ability to pay principle, right? So remember, if you don't get any cash, you can't go to Vegas and buy shrooms. When you can't go to Vegas and buy shrooms, there's no recognition. Because under ability to pay, you don't have any cash to pay it. So the tax code, it understands that. And it says, okay, when you have a like-kind exchange, we're not going to let you recognize any gain or loss. That's it. That's the rule. No recognition. So to qualify as a like-kind exchange, you have to meet 3 criteria. First, the property is exchanged solely for like-kind property. So machine for machine. We're going to talk about why that really isn't like-kind in a second. Both the property given up and the property received have to be used in a trade or business or held for investment. So that means I own a home that I live in Poway. Let's decide I retire, which you guys would think was awesome, and I decide to move to Florida, and so I just exchange homes with someone. Well, I didn't use my home in a trade or business, and I can't argue that I held it for investment because I lived in it. As a result, that would not qualify for like-kind exchange treatment. And lastly, the exchange must meet certain time restrictions. I think the book does a decent job of talking about delayed transactions. I'm not going to get too mixed up in that. Like-kind treatment is not elective. If you meet the like-kind exchange rules, you do not recognize gain or loss, period. So what's the definition of like-kind property? If it's real property, then it's property used in a trade or business held for investment, and it's considered like-kind with any other real property used in a trade or business and held for investment. So we consider that a fairly loose definition of like-kind. So a warehouse for an office building? Yep. An apartment building for a warehouse? Yep. Those are both like-kind. Okay. Personal property used to be, notice I said used to be considered like-kind if it had the same general use and again was used for business or held investment. And there was a safe harbor if it had the same class life. However, in 2018, personal property was removed from the like-kind exchange rules. So 2018 going forward, only real property qualifies for like-kind. Okay. Other things that aren't like-kind, inventory, most financial instruments, stocks, bonds, partnership interests. You can't exchange U.S. property for foreign property at all. The timing requirements, I said, you can read the book on that. right? When they deal with intermediaries. Oh, sorry. I had a nice visual, right? So in 2018, personal property disappeared. Okay. So SpongeBob has a pineapple-shaped rental condo. Basis 25,000, fair market 200,000. Patrick owns a rock-shaped rental condo in Tahoe. Its fair market value is 150,000. His basis is 100,000. So these are both rentals. They've both decided they want to change. So they're going to exchange the two of them with each other, but they're going to continue to use them as rental properties. Okay. So when SpongeBob's looks at this, he says, well, wait a second. If I'm going to exchange this, why am I going to give you something worth 200,000 for something worth 150,000? Excuse me one second. Well, there's no way SpongeBob would do that, because he's getting a better deal. So SpongeBob says, all right, well, I'll take the rock, but you got to give me 50 grand too. So the real exchange is SpongeBob's pineapple for Patrick's rock plus 50 grand. However, if we assume this is a like-kind exchange, SpongeBob says, wait a second, I got 50,000 bucks in my pocket. Guess where I'm going? Well, SpongeBob's going to Reno because he just moved to Tahoe, but otherwise, he's going to Vegas to buy shrooms, right? We know that if someone walks away with money in their pocket so they can go to Vegas and buy shrooms, there's going to be a recognition problem. And sure enough, there is. So let's look at what each party gives up and gets. So first, SpongeBob. SpongeBob gives up a condo, fair market value 200,000. What's he get? He gets a Tahoe condo worth 150 and cash of 50. Patrick gives up the Tahoe condo plus cash of 50. He gets the Bikini Bottom condo for 200,000. There is an underlying presumption in all like-kind exchanges that the fair market value of what you give up and what you get must equal. People simply don't enter into transactions where that's not the case. Now, we can dicker about what the market value is, but presumably I don't give up anything that I don't feel is worth what I'm getting. If that's not the case, I don't have a like-kind exchange. Okay, let's focus on SpongeBob. So SpongeBob gets cash and he goes to Reno. We know that. So he has the ability to pay tax, and thus, guess what? He's going to pay tax. We call any cash or non-like-kind property excluded in an exchange, we call that boot. Again, I didn't make this word up, but the lawyers did 250 years ago. And so we still call it boot. So what happens is when I have a like-kind exchange and it involves cash or non-like-kind property, then I have to recognize any realized gain to the extent of the boot received. Now, I can tell you that, first off, that should say any. But that is a super powerful statement, because if you can memorize that one statement, you can do all like-kind exchanges. I must recognize any realized gain to the extent of the boot received. Let's look at SpongeBob. The amount realized, 200,000. His basis in his condo is 25,000. His realized gain, therefore, is 175,000, right? I have a sale, exchange, or disposition. That means amount realized minus adjusted basis. His realized gain is 175. He received boot of 50,000. Therefore, he will recognize gain to the extent of the boot received, or 50,000. The remaining gain of 125 can be deferred under the like-kind, or must be deferred under the like-kind exchange rules. Let's look at Patrick. What did Patrick get? Patrick got a Bikini Bottom condo worth 200,000. What is his basis? Be careful, because this isn't really explicit on this slide. The basis in his rock was 100,000, but he also gave up 50,000 in cash. So the basis of what he gave up is 150,000. Therefore, his realized gain is 50,000. Did Patrick receive any boot? The answer is no. He paid boot, but he received no boot. As a result, he recognizes no gain. His entire gain of 50,000 is simply deferred. All right. So if debt happens to be assumed as part of the exchange, that's treated as boot. So this is kind of unfair. So let's say that instead of Patrick paying SpongeBob 50,000, let's assume for a moment that SpongeBob's pineapple had a $50,000 mortgage on it. And when Patrick did the exchange, he agreed to assume that mortgage. So what that means is SpongeBob still gets $200,000. He gets Patrick's $150,000 condo, and someone assumes away his liability. Remember the definition of amount realized? It included when the buyer assumes your liability. So his amount realized is still $200,000. The problem is we're still going to treat that $50,000 assumption of debt as boot. The reason that doesn't work for me personally, even though that's the way the rules work, is that SpongeBob doesn't have any cash, right? Now, the problem is someone just took over his mortgage. He didn't end up with $50,000 in his pocket. He didn't go into Vegas to buy shrooms. All the same, that assumption of liability will be treated as boot. Okay, basis of property received in the exchange. So now we know that SpongeBob owns a rock. And he's using that rock in a trade or business or for investment, which means that he's going to depreciate it. So if he's going to depreciate it, we need to understand what is his basis in this new rock. And there's a general rule in the tax code, and we're going to trip into this again before we're done this semester. The general rule says that when there's a non-recognition transaction, that the basis simply carries over. So whatever his basis was in the old property simply becomes the basis in the new property. That's the general rule in a non-recognition transaction. So you should think anytime there's no recognition, the basis probably carries over. So, however, you have to adjust that basis for boot and gain. So you either recognize a gain because you received boot, or you don't recognize any loss, but you gave away boot. So these are mutually exclusive definitions, right? So basis of old, that would be a situation like SpongeBob. The basis of his old pineapple plus any gain he realized minus any boot he received. Patrick is a better example of the second definition. It's the basis of his old rock plus any boot given. Let's look at the calculations. So let's start with SpongeBob. SpongeBob's old basis in his pineapple is $25,000. Recall he recognized gain of $50,000. That's because he received boot of $50,000. His new basis is $25,000. Look at that. The general rule applies. The basis in his old property is the basis in his new property. So he's got a rock and he just starts depreciating the $25,000, right? So from a tax perspective, since the economics haven't changed, they're down with that. It's like, yeah, you just got to keep depreciating that same $25,000 asset. Patrick, on the other hand, his old basis was $100,000, but Patrick gave up boot of $50,000. As a result, his new basis is $150,000. So that means he gets to depreciate starting at $150,000. Another way of defining it, some people like this definition, some people don't. The last one always works. This one always works too. The basis in the like-kind property is the fair market value of any like-kind property you received minus any deferred gain or plus any deferred loss. Again, you can't have both. You either have a deferred gain or you have a deferred loss. And you could go back through the SpongeBob example, because I don't think it's on the next slide, and you could recalculate basis the same way, and you're going to get the same answers you did with the previous formula. Some people like this formula because it's easier to remember. All right, so Wubzy owns an office building. And Wubzy's office building is one that he leases to a major department store. And on June 1st of 2016, the building is completely destroyed by a fire. But Wubzy has insurance. He's not dumb. And the insurance pays him $1.2 million. Okay, so as it stands right now, Wubzy had a building. It was a trade or business building. He had a basis in it. It was destroyed by a fire. And the insurance company just gave him $1.2 million. Okay, so his basis in the building was $900,000. Wubzy has a new office building that is constructed and leased at a cost of $1.3 million. What is Wubzy's realized and recognized gain or loss in the new building? Okay, so first I want to think about Wubzy's situation. Unfortunately, a conversion, if you go back to our list, a conversion is a realization event. A realization event means amount realized minus adjusted basis equals realized gain or loss. So if I look at this problem and I see that I have a conversion, I'd say, well, what's the amount realized? Well, the insurance company paid him $1.2 million. What was his adjusted basis? $900,000. That's a $300,000 gain. Does he have cash in his pocket? Well, maybe he does, maybe he doesn't, right? If he does, he's going to Vegas, he's buying shrooms, he's got to pay tax. If he doesn't end up with any cash in his pocket, then we shouldn't make him pay any tax, because under the ability to pay, he doesn't have the ability to pay. So this all depends on whether or not he takes the proceeds from that insurance and reinvests it in replacement property. So what did he do? He took the proceeds and he reinvested them in a new building at a cost of $1.3 million. Okay, so that means not only did he spend all the insurance proceeds, he spent $100,000 of his own money as well. Should he have to recognize any gain on that and pay tax? Well, the answer is no. It's not like he meant to sell it. There was a fire, it destroyed it. So what we would do is we would treat that as an involuntary conversion. And when you have an involuntary conversion, gain is deferred. Gain only, not losses. Gains are deferred when appreciated property is involuntarily converted in an accident or natural disaster. The basis of the property, guess what? In a non-recognition transaction, carries over. In an indirect conversion, gain recognized is the lesser of the gain realized or the amount not reinvested. Okay, so we can apply that rule. We'll get there. Qualified replacement property must be of a similar or related use to the original property. So 1033 says, if property as a result of its destruction in whole, in part, theft, seizure, condemnation, threat, imminence thereof, is compulsory, I can't say that word, or involuntary converted. Conversion into similar property, no gain shall be recognized. Conversion into money, going to Vegas buying shrooms, gain shall be recognized. Okay, I get it. This sounds just like a like-kind exchange, right? If I get boot, if I end up with cash, I'm going to Vegas, I'm buying shrooms, I got to pay tax. If I don't, it's a like-kind exchange, I don't pay any tax. So what is it to replace it with property similar or related in service or use? Well, you have to apply two tests. There's the functional use test that says the character of service or use must be the same for both properties. So remember, under a like-kind exchange, I can exchange a warehouse for an office building. That doesn't work for an involuntary conversion. If my warehouse burns down, I have to build a warehouse in order for it to be treated as property similar. Rental properties, however, have a relaxed standard. So if I had a building and I rented it to someone else who used it as a warehouse and it burns down, I can build anything there as long as I rent it. I can build a shopping mall as long as I rent it out to customers, that's fine. So there's a relaxed standard for rentals. Condemned real estate, so if for some reason the city condemns my property, because that's an involuntary conversion, it's like-kind rules. Pretty much any realty for any realty will do. And when you think about that, that makes good sense. If my building just got condemned, it got condemned. I can't make it into something else. So there's a pretty good bet the city condemned it, took it over. They're putting a highway on it. They're giving me some other property in exchange. So kind of any for realty is going to do. The timing for replacement, again, the book does an adequate job with that. So here we are back with Wubzy. So Wubzy has the insurance at $1.2 million. His basis is $900,000. Insurance pays him the 1.2. He invests 1.3 in a new building. So the amount realized, 1.2. The adjusted basis, $900,000. His realized gain is $300,000. Did he get any boot? Well, his proceeds were 1.2. He reinvested 1.3. So no, there's no cash in his pocket. There's no shrooms in his future. There's no Vegas in his future. So if we call that boot, technically it's called excess proceeds. If we call that boot, there is no boot. As a result, there is no gain recognized. When we think about what is his basis in the new building, this is where that previous rule for like-kind exchanges comes in pretty handy. What's the fair market value of his new building? Well, it's $1.3 million. That's what he just spent on it. What is his deferred gain? $300,000. So what's his basis in the new building? $1 million. Let me give you a different way of thinking about it. His basis in the old building was $900,000. The general rule is it just carries over, right? So we'd say, well, wait, his carryover basis should be $900,000. But didn't he invest an additional $100,000 of his own money, right? He invested 1.3. He only got 1.2. Take that additional $100,000, put it in his basis, we get to $1 million. All right. Iteration number 2. By the way, that was Wubzy, for those of you who don't know who it is. Wubzy owns an office building. Building's destroyed in a fire. Insurance pays him 1.2. His adjusted basis is $900,000. This time he builds a new building at a cost of $1 million. All right, I'm already sensing, yeah, it's true. Wubzy's on a plane. Where's he going? He's going to Vegas. What's he going to buy? Bag of shrooms. There he goes. He's going to pay tax. So let's look at this one. Amount realized 1.2. His adjusted basis 9. His realized gain is 300,000. Now we got to calculate that excess proceeds. The insurance company gave him 2.2 million. What did he reinvest? He only reinvested $1 million. He's got 200,000 of excess proceeds. Therefore, he'll recognize gain of 200,000. His basis in the new building. Two ways of looking at it. It's either the fair market value of his new building, $1 million, minus the amount of gain he didn't recognize, the deferred gain, 100,000, or it's just a carryover basis, 900,000. Awesome. Oh, that's Vegas Shrooms Wubzy version, right? I guess that's what it looks like. All right, one last example. I think, there's a little bit. There's a short one after this, but we're getting close, thankfully. Obama sold used equipment to Donald for $100,000 with $10,000 down and a 7% note for the balance payable in 3 installments of $30,000 of principal plus interest payable in the next 3 years. So I don't know why it says Donald's basis was $20,000. This should say Obama's basis right here. This is Obama's basis was 20,000. All right, I have a sale, exchange, or disposition. That means I have amount realized and adjusted basis. So I need to figure out what these are. So what did Obama get? Well, he got 10,000 down, and he got a 7% note for 3 installments of 30,000. So it sounds to me like his amount realized is 100,000. That's the 10,000 down plus a note with a market value of $90,000, because that's what he's going to receive. He's going to get that over 3 years, but all the same, he got it. His adjusted basis is 20,000, realized gain of 80,000. Normally, you'd think of there'd be a recognized gain for 80,000. That's the general rule. Here's the problem. How much cash does Obama have? Well, he got 10,000 down. So it's not like he got nothing. He got something, but can he go to Vegas and buy shrooms? That's the question, right? And the answer is no. That's why there's something called installment sale treatment. So this is a taxpayer-friendly provision in the code, like the other previous two, that say, you know what we're trying to do is match the receipt of cash with the timing to pay the tax on it. Under an installment sale, if you sell property where the seller receives the sale proceeds in more than one period, then what happens is you recognize a portion of the gain each time you're paid. So that means over 3 years, I recognize a little bit of gain in the first year, a little bit of gain in the second year, a little bit of gain in the third year, right? And I do that on a pro rata basis over the 3 years. So the question is, well, what is the portion I need to recognize? That's called the gross profit percentage. What you do is you take the gain realized divided by the amount realized. That gives you the gross profit percentage that you apply against each receipt of cash. So sales of things like inventory, marketable securities, and depreciation recapture, right? So that 1245 recapture cannot be accounted for under the installment sale rules, and installment sale rules never apply to losses. Now, no one would want to defer their losses anyway. They would always want to recognize their losses. So it makes sense that installment sale doesn't apply to losses. So let's go back to Obama. Let's determine his gross profit percentage. Let's flip back to that slide for a second. There it is. So what was his realized gain? It was 80,000. What was his amount realized? That was 100,000. That means his gross profit percentage is 80%, which means that every dollar Donald pays him, 80 cents of that is going to be gain. Okay, so there's the amount realized, the adjusted basis, the realized gain. Now, when I calculate the recognized gain, I need to do it for each year that it occurs. So in year 0, remember, Donald paid him 10,000 down. He takes 80% of that. His taxable gain is 8,000. Now, that taxable gain could be 1231 long term. It could be short term. Like, you have to figure out what the rate that applies to it is. But assuming that this is trade or business property, like some sort of rental property or something like that, chances are the gain might be subject to recapture. But if it's not, then he'd recognize 8,000 and pay tax on it. In year one, Donald's going to pay him $30,000. 80% of every dollar is gain, so $24,000 is taxable gain. Year two, another $30,000 comes in, another taxable gain. Year three, the final $30,000 comes in, the final amount is paid as taxable gain. Note, this is important. The total amount of gain recognized is $80,000. That's the same as it is as if he recognized all of it in the year of sale, right? So what does the installment sale method do? It changes the timing of recognition, just like like-kind exchanges, just like involuntary conversions. These things defer those gains until some future event occurs. In this case, it's until you receive the cash. Two important things to note here. The first is interest will always be recognized separately as interest income, right? The second thing we just discussed. What about recapture? So the problem is if there's recapture on an installment sale, the tax code says, I'm not going to let you defer that. You've been taking deductions for that when there was no economic deduction. You've been writing those costs off as depreciation. To the extent I'm going to make you recapture that under 1245, I'm not going to let you defer it any longer. You have to recognize that part in the year of sale. So let's re-examine Obama Donald and assume the original cost was $70,000. The basis was $20,000. He sold it for $100. So the realized gain is still $80,000. But in this situation, we'd have 1245 recapture of the amount of depreciation. What you'd have to do is recognize that recapture in the year of sale. So that means 50 of that 80 gain is recognized in the year of sale. The remaining 30,000 I can defer using the installment method, which means my gross profit percentage is the 30,000 of gain to recognize under the installment method divided by 100,000. Now it's only 30%. I'd chuck that into my calendar and I'd get the same gain recognition amount. So look at how, though, the total gain is still the same. So in the year one, I recognize a little bit on the cash he paid me, right? 30% on the cash he paid me and all of the recapture. So technically 53,000 in year one. Then 9,000, 9,000, 9,000. The total gain recognized, 80,000. Same as the realized gain. So again, all we're doing is shifting timing. So let's say Donald owns 100 shares of stock in MySpace. He purchased it at $100 a share. I'm really picking on Donald today. That's not fair. So it is now worth $2 a share. And if MySpace is worth $2 a share, I'd be surprised. But in any event, in our example, it's worth $2 a share. Donald wants to recognize the loss, but he's not quite ready to give up on MySpace, thinking it might be the next Twitter. And he knows the wash sale rules, right, from Module 2. Donald's not an idiot, even though he bought MySpace. He knows the wash sale rules, and he says, look, I could sell the MySpace and then just rebuy it. That would be one technique, but the loss would be captured, right? I have a $98 per share loss. The wash sale rules are going to disallow that and not allow me to recognize the loss anyway. So I got to come up with a better plan, right? I want this loss, but I don't want to lose my access to MySpace. So I'm just going to sell it to my own corporation, right? So I'm going to sell the $200 minus the $1,000 gain. So I think that should be $2,000 minus $10,000, an $8,000 loss. But whatever, we could do it on a per share basis. I have a loss now because I sold it to a related party. Well, the rules simply don't permit that. So under 267, you are disallowed from recognizing a loss on a sale between related parties. Clearly, Donald and his wholly owned corporation are related parties. That loss will be disallowed. However, if it's ultimately sold to a third party, Trump could try and capture the deferred loss. So let's do 3 iterations. The first is Trump Corp goes ahead and sells it for $1,200. In the second iteration, Trump Corp sells it for $800. And in the third iteration, it only sells it for $100. So let's see what happens. So here's our first iteration. Donald sells it first to his own corporation. The amount realized, $200, is adjusted basis, $1,000. He realizes an $800 loss. He's unable to recognize any of that under the disallowed loss rules, so it's all deferred. Then Trump Corp turns around and sells it for $1,200. Now, the adjusted basis of Trump Corp is $200. That's what they paid Donald for it. Their realized gain is $1,000. under the related party loss rules, they're allowed to include Donald's deferred loss as part of their gain loss calculation. As a result, it reduces their gain to only 200. So if you think about it, when you sell it outside the family, that's when you can recognize that deferred loss. All right, now let's look at a second iteration if he sells it for 800. So if he sells it to his corporation for 200, everything's the same. Now Trump Corp sells it for 800. The amount realized 800, their base is 200. The realized gain or loss is 600. They are not allowed to capture any more than their realized gain. So they can't deduct all 800 of Donald's loss. They can only capture 600 of his deferred loss. Well, as a result, they don't have any recognized gain or loss. But what happens to the other 200? There's another $200 loss that was deferred that didn't get recognized. Well, it evaporates. There's no carry forward on it. It's simply gone. That's the risk of selling something to a related party. The risk is if it's at a loss, that loss may just simply evaporate on you. Okay, now let's go to the third iteration. Donald sells it to Trump Corp, then Trump Corp turns around. This is the realistic one, right? Trump Corp will be lucky to get $100 for MySpace. But in any event, the amount realized is $100. The adjusted basis is 200. They have a realized gain or loss of 100. None of Donald's deferred loss can be recaptured. It all just evaporates. Therefore, the recognized gain or loss for Trump Corp is $100, and it's done. All 800 evaporates. So this is the related the related party loss rules under 267. That brings us to the conclusion of Chapter 11. I know I mentioned on the front slide that we were going to talk about personal use property. So there's not a slide for that. So I feel like I got to chuck it in, though I think I covered it in Chapter 7. But just to be safe, if I sell personal use property at a loss, I may not deduct the loss. If I sell personal use property at a gain, I have to recognize the gain. So that's the asymmetry in the rules. So let me give you an example. I buy a car, it's personal use. Cars are not depreciable because they're almost always personal use, right? So my car is, I only use it for commuting. I can't depreciate it just for commuting. So as a result, it goes down in value, but its basis doesn't change. So when I sell it, that's at a loss. Well, that's a non-recognizable loss on a personal use asset. Let's say, on the other hand, I buy a car and it's a Butte. And so I put a cover on it and I store it in my garage for 25 years. And now it's an antique. And I roll that thing out and I sell it to an antique dealer. Now it's actually gone up in value. So I sell a personal use asset at a gain that I have to recognize and pay tax on. All right, now we're officially done. So before I close this down, if you guys have any questions, feel free to shoot out a chat to me now. Got a bunch of homework problems. Recapture's tough. If you struggle with it, post it to the discussion board, right? Let's see if we can work it out jointly with each other. I don't see any questions coming through, so as a result, I think we're done. For those of you that stuck this out for the last 3 hours, I appreciate it. Going forward, we're done with live lecture. Everything else goes to canned videos. So it'll be back to play, pause it. You'll be able to take quizzes as you watch the videos or not, depending on what you want to do. And they'll be chunked into very small segments like you're used to. So for those of you that didn't watch, I have to record this now, upload it, and then download it to YouTube and post it into Blackboard. That takes about 3 hours, but I will get it out there as soon as I can. Thanks for watching, you guys.